We're in a risk-off environment. Gold is down. The gold stocks are down. A higher U.S. interest rate leads to a higher U.S. dollar. Gold is denominated in dollars. So it wouldn't surprise me, given that you need to consider both the numerator and the denominator, that the gold price falters in the face of higher interest rates. Make no mistake, we can't afford real interest rates.
What is Rick Rule doing right now in terms of investments in the precious metals industry? Are you just holding what you got? Are you nibbling on stuff? Are you...
But I'm changing the risk. I'm doing the opposite of what I told your listeners to do a year ago. And I'm deploying new money in the riskiest part of the sector, that the cure for high prices is high prices.
In terms of the global scramble to build out compute, so the data center build out wave, are there commodities that are at the top of your list that you think will benefit the most from that? Like copper seems to be one that comes to mind. I'm going to guess maybe natural gas to be used as the bridge fuel for a lot of these things that need their own power. Maybe nuclear, with the SMRs and stuff like that.
The marginal buyer, which is the one who sets the prices, will need to boycott energy.
All right. I know a lot of people probably would have wanted me to have started with this question, but is the bottom in for precious metals? They've definitely had a pretty rough time recently. And before you answer, I just want to give you public props for your wisdom in getting out when you did on the way up with the precious metals. You took a lot of slings and arrows when you sold your silver at $75 an ounce. It's interesting, Rick, just the other day, somebody recirculated a tweet I made when I was at the Vancouver Resource Investment Conference earlier this year. And it was a tweet of you on stage with Quartermain and one other gentleman, but basically the old Vanguard.
Yeah.
And you guys were saying, look, we've seen this movie before. The price action's gotten crazy here, folks. I hate to tell you, but this is kind of a mania that's going to end soon. And we're stepping back, we're reducing our exposure. And you guys got so much guff for that from the folks that just didn't want to hear any bad news and thought, hey, this is the repricing we've all been waiting for. And once again, your wisdom and experience proved out over time. So I want to give you, full kudos for sticking your neck out when you knew it wasn't the popular message.
Well, I've noticed that whenever I do something that's immediately unpopular, I'm invariably right. When you see a hyperbolic chart, that chart almost always resolves.
Sure, vertical moves don't end by going sideways.
Yeah, the Canadians call that a hockey stick chart.
The most dangerous phase of a bull market is usually when investors stop asking what price already assumes. Rick Rule notes that parabolic moves rarely end with orderly consolidation, and that matters more than sentiment surveys or social media conviction. When experienced capital reduces exposure into euphoria, retail often mistakes discipline for betrayal. Wealth destruction usually starts when investors confuse a repricing thesis with immunity from cycles. Next, Rick Rule exposes why the interest rate narrative may be setting up the opposite outcome precious metals investors expect.
The backside of a hockey stick is just as steep as the front side, but it's a lot less fun if you're long. I'm not a trader, but when I see a hyperbolic chart up or down, I bet against it. I just can't help myself. In this case, I had fundamentals on my side. I'm not sure that the low is in for precious metals. I suspect that nominal interest rates will continue until this administration loses its courage and forces them down. And a higher U.S. interest rate leads to a higher U.S. dollar. Gold is denominated in dollars. So it wouldn't surprise me, given that you need to consider both the numerator and the denominator, that the gold price falters in the face of higher interest rates. Make no mistake, we can't afford real interest rates. The interest on the U.S. debt and the fact that higher interest rates, if they continue higher, will decimate the long bond market when the U.S. government needs to refinance, and ultimately equity markets and consumer durable markets and the housing market means that eventually, like 1975, the political class and the voters will lose their nerve. And they will sacrifice the sanctity of the US dollar to domestic politics. When that happens, like at the end of 1975, gold will be a beneficiary. Will that occur in 2026? I have no earthly idea. Will it occur? Absolutely.
Okay, so if you don't mind sharing, what is Rick Rule doing right now in terms of investments in the precious metals industry? Are you just holding what you got? Are you nibbling on stuff? Or are you just staying away until you start to see signs of what you just talked about?
The market says higher rates prove strength, but debt math says the system cannot tolerate that story for long. According to Rick Rule, rising nominal rates can pressure gold in the short run, yet the deeper contradiction sits beneath the surface. Governments that depend on refinancing eventually collide with the cost of defending their currency. Savers focusing only on spot prices risk missing the policy pivot that historically changes everything. Next, Rick Rule reveals the hidden point where protecting the dollar starts threatening the financial system itself.
I'm a saver in gold, and I save whenever I have a liquidity event. I'll
Okay.
make a fair bit of money on this conference, and I'll put some of it in gold. That's just what I do. I save systematically in gold, and I'm fairly price insensitive. On the gold stocks, I'm starting to take more risk. We're in a risk-off environment. Gold is down. The gold stocks are down. The ones that are down the most are the ones that are perceived as being riskiest. At the same time that after 2.5 years of increased exploration spend, I'm starting to see some great exploration results.
Hmm.
So I see some drill holes that give me spectacular data. And while the market moves, it doesn't move anywhere near the way it used to move. So I'm increasing rather dramatically my risk appetite. I'm not increasing the amount of money I have exposed too much, albeit I have a lot exposed, but I'm changing the risk. I'm doing the opposite of what I told your listeners to do a year ago when I said emphasize the biggest and the best. I
So
personally,
you're lightening up on the majors and putting more
I'm
in
not
the.
lightening up on the majors. I'm right now. I'm making a fair bit of money, and I'm deploying new money, in the riskiest part of the sector.
Okay. All right. And in terms of where Rick thinks the riskier part of the sector is, where he sees the most opportunity, the best way to find that out, folks, is to attend the Rural Symposium coming up in a couple of weeks. So we'll talk about that in a minute. That's why I'm not digging in with him now.
Well done.
Um, all right. Last topic. Again, we could talk an hour about it, but let's just do a couple minutes.
When quality gets crowded, the next phase of money often moves where headlines still refuse to look. What Rick Rule is highlighting is not bigger exposure, but different exposure, shifting incremental capital toward assets punished harder than fundamentals justify. Exploration spending has already occurred, yet valuations still imply disappointment. For investors protecting wealth, the lesson isn't chasing risk, it's understanding where fear has become mechanically priced in. Next, Rick Rule unravels why institutional caution and selective speculation are happening at the exact same time.
So this video is going to release, you know, at some point in the next couple of days, Rick. And I have no idea what the world's going to look like then versus now. You know, we just have every day we've got different news about peace deals and going back to war and all that type of stuff. So who knows what it's going to be like. But when just getting back to oil briefly, I'm trying to think where to go about this. I guess I want to get your general outlook, but one of the things you were talking about earlier was about how the world, you know, underinvested in exploration and was going to have to get religion about, you know, if we want to power the future, we're going to have to really explore and produce a lot more. And nobody expected the war. The war happened, 20% of the world's oil flow got cut off overnight. And one of the things I've been talking a lot about recently, and this is really, really want to hear your expertise, is the global economy is reflexive, right? So, you know, yes, 20% of what we were getting worldwide got caught up in the Gulf. But the countries that are next net exporters went into overdrive, right? And so I'm curious, like, is that pulling ahead some of the work we needed to do to realize, hey, we gotta get more aggressive here? Like, are we already kickstarting that process here? Because we actually have both an economic opportunity, the net exporters do, and the world needs alternative sources. It's a, hey, look, you know what, we maybe underestimated the geopolitical risk here. And so in some ways, could this be a benefit to the world because we are starting to accelerate that process?
Supply shocks never create shortages from nothing. They expose years of ignored decisions all at once. Rick Rule's argument suggests that conflict matters less than what it accelerates beneath the surface. Capital allocation. Markets suddenly rediscover energy security only after price forces attention, even though underinvestment signals existed long before headlines arrived. Investors waiting for certainty usually enter after the economics have already changed. Next, Rick Rule reveals why higher prices may be functioning as policy faster than governments can.
Of finding ways to produce more around the world.
We need to accelerate investment. The United States has a temporary surplus of natural gas produced as a byproduct of oil.
Right.
You and I have talked about this in the past. We right now can export that natural gas as liquefied natural gas. When U.S. oil exports are totaled, they aren't oil. They're mostly natural gas. We
Mm-hmm.
had some spare capacity. The Venezuelans had some spare capacity, which they're now starting to pull, but they haven't made the sustaining capital investments, nor have we. At
Sorry,
prices,
sorry to interject, but I just want you to include this in your answer. But are we headed in the right direction? And Venezuela is a great example of that. It was a field that was really poorly tapped up until Maduro was launched, and I realized we can't change it overnight. But are we creating the conditions to start making those sustainable investments there?
not yet.
Not
Uh,
yet. Okay.
in the United States, now, to be sure, $90 oil makes a whole bunch of our tier two locations tier one
Economically viable.
locations.
Yeah.
And you are now starting to see in the Permian Basin and the Delaware Basin a lot of stacked rigs that are turning. And they're turning in response to today's prices. And they're
Hmm.
turning in response to the fact that they can sell their gas. So that's happening. And that's very, very, very beneficial. You will know the world's gotten their message when analysts say to companies, reduce your share buybacks, reduce the percentage of free cash flow that's going to dividends, and increase the amount of your free cash flow that's going to increase your oil production 3 years from now, 4 years from now, 5 years from now. In other words, stop cannibalizing to subsidize shareholders today
Hmm.
and think about shareholder returns 3, 4, and 5 years from now. When you
Right.
see that occur, it's not occurring except at places like Exxon.
Wall Street celebrates buybacks because future production doesn't show up in next quarter's earnings. This is where Rick Rule's thesis shifts. The real signal isn't oil price strength, but whether capital stops rewarding extraction and starts rewarding replacement. Companies returning cash while starving future supply create temporary investor comfort and long-term scarcity. Savers should watch capex budgets more closely than television price targets. Next, Rick Rule exposes the contradiction between shareholder rewards today and energy availability tomorrow.
Then you'll know that we've got the message.
Is it not occurring because the shareholders are demanding getting paid now, or is it not
It's,
occurring because the management is thinking
Shareholders
differently?
are always rear looking. That's the way it works. Your opinion
Hmm.
of the future is set by your experience in the immediate past.
All right, Rick, last question for you in oil, then we'll wrap up. I've been trying to set up an interview with Jeff Curry, who I believe you know, commodity specialist, and he's been in the media a lot recently, ringing a pretty loud warning bell about global inventories, that they've been brought down so low that even if the Strait of Hormuz, opens quickly and oil starts flowing again through the Gulf, that the shock waves of having brought oil supplies down this low could keep oil prices a lot higher for a lot longer than currently the market's expecting. Do you have an opinion on that?
I'm going to have to defer to Mr. Curry.
Okay.
He's been a market student at Goldman Sachs for a very long time, and I'm a rockhound. So I think we have different areas of expertise, and I suspect that he's a better pundit. I will tell you that the cure for high prices is high prices.
Hmm.
And at these oil prices, while it doesn't do much to deter in the near term US demand, it obliterates demand in markets that can't afford it.
Yep.
And my suspicion is that the marginal buyer, which is the one who sets the prices, uh, will need to boycott energy. If the price of oil in Reno if the price of gasoline in Reno goes up, you curse and then you start your car and drive somewhere. If the price of gasoline in Colombo in Sri Lanka goes up, the taxi driver parks his cab.
Right.
It's a very different response.
The people who determine commodity prices are often the first people forced out of the market. Rick Rule notes that demand destruction isn't evenly distributed. Wealthier economies absorb shocks while marginal buyers disappear. That creates the illusion of resilience right until inventories tighten and prices stay elevated longer than expected. Investors focused only on domestic conditions can miss where global pricing pressure actually begins. Next, Rick Rule reveals why the market's assumption of fast normalization may depend on demand that no longer exists.
In terms of the global scramble to build out compute, so the data center build out wave, are there commodities that are at the top of your list that you think will benefit the most from that? Like copper seems to be one that comes to mind. I'm going to guess maybe natural gas to be used as the bridge fuel for a lot of these things that need their own power. Maybe nuclear, with the SMRs and stuff like that. But like, what would you think would be benefiting in the near term from this huge demand to build out the data centers?
I mean, pick one, but from an investment theme, you need to pick a big one. You need to pick a big one because you could look at something like titanium or vanadium, and you have one big new deposit that comes on, and it cracks the market.
Mm-hmm.
We found that you make a lot of money if you're on the right side of a commodity boom around a small commodity, and then you get your ass kicked if the market and technology works and supply suddenly increases.
Mm-hmm.
So to play the game successfully, you need big markets. You need markets, you need energy markets or copper markets. The truth is, if the AI circumstance that you describe and the demographics that we believe occur over the next 20 years occurs, uh, copper, which is a great big market, will do extraordinarily well.
Well.
There's nothing we can do to alter copper supply in a reasonable time frame. We can alter price by having a depression, and listeners of yours who are afraid of a depression should avoid, until a depression occurs, the copper market. But to the extent that there are people who believe that we'll muddle through, with or without AI, but particularly with AI, that's a
Mm-hmm.
no-brainer.
Markets are pricing AI like software while ignoring that the bottleneck may end up being rock, steel, and electricity. According to Rick Rule, the opportunity isn't necessarily in exotic materials, but in markets too large to be disrupted overnight. The contradiction is that investors chase the newest technology while underestimating the oldest constraint: physical supply. If compute demand compounds faster than extraction capacity, portfolios built around digital abundance may discover commodity scarcity. Next, Rick Rule exposes why the AI story could become less about chips and more about the metals beneath them.
The surprise winner in a lot of discussions, Adam, I think has to be uranium. Uh, it isn't merely that AI will require prodigious amounts of uninterruptible power, which is to say, not wind or solar,
Mm-hmm.
but rather 24/7 power. Uranium does that. And the AI elite also requires non-carbon generating power,
Mm-hmm.
which uranium offers. On top of that, uh, the unsung beneficiary of the conflict in the Straits of Hormuz is truly uranium. You will recall, Adam, maybe you're not as old as I, but you're a student of history.
I got some gray, don't worry.
You will recall, or you may recall, that the Arab oil embargo of 1973 was the impetus for the beginning of the greatest build out in nuclear history.
Mm-hmm.
The French nuclear fleet, now the world's fourth largest, was built as a direct consequence to France's insecurity with regards to the importation uh, of energy.
Foreign oil, yeah, yeah.
The Japanese fleet, the third largest, was born of the same circumstance. It was stated in the Japanese Diet, their parliament, that uranium is the only fuel in the world that has sufficient energy density that Japan could, in one warehouse, store enough energy to power Japan Inc. for 5 years.
Hmm.
The concept of energy security, geopolitical energy security, has returned to our consciousness after a 50-year absence. And the only material that gives us sufficient energy density that a nation that is insufficient in energy resources, which is most nations in the world, the only way that you deal with that is uranium. You cannot store that much coal. You can't store that much oil or liquefied natural gas. You sure can't store that much wind or that much
Right.
sunshine. It's only uranium. Now, does this manifest itself in 2026? Probably not.
The energy transition story changes fast when reliability becomes more important than messaging. What Rick Rule is highlighting is that AI demand and energy security may be converging into the same trade after decades of being treated separately. Institutions publicly emphasize flexibility and diversification, while quietly rediscovering dense, dependable baseload power. Investors waiting for official consensus often miss the repricing phase created by infrastructure decisions already underway. Next, Rick Rule reveals why the public clean energy narrative may end with a fuel many investors stopped watching years ago.
Does it manifest itself over the 5 or 10 years? Absent a Chernobyl or a Fukushima, absent a catastrophe,
Yep.
the probability that uranium is the fuel of the AI business is 100%.
Okay. And when you say that, how much of that future demand, fuel demand, is going to be existing conventional nuclear power plants versus a brand new fleet of, smaller reactors that have, different technologies, smaller footprints, and so a lot of the safety risks are much more moderated. But they also let you have, on-site power generation at these places. You don't need to have grid dependency. You can put these things pretty much anywhere in the world.
I disgraced myself at a conference a couple of years ago talking about the fact that SMRs were the technology of the future. And a gentleman in the audience raised his hand and said, Mr. Rule, the future has been operated by the U.S. Navy for
Right.
25 years.
Exactly. Yeah. I mean, that's what a submarine is,
But the truth is
a nuclear
that it's
submarine.
going to be driven by all kinds of technology.
The biggest investment themes often look obvious only after infrastructure already exists in plain sight. Rick Rule's argument suggests that investors may be overestimating invention and underestimating deployment. Small modular reactors feel futuristic, yet compact nuclear systems have operated for decades in environments where failure wasn't optional. For long-term capital preservation, the question isn't which technology wins. It's which supply chains benefit regardless of branding.